Hey there, we are live. Welcome to Be the Boss of Your Money. If we haven't met yet, I'm Mitch Goldberg. I'm a financial advisor. I have 30 years of experience working directly with clients, with retail clients like yourself. The reason for the show is to make you your best possible version of your financial self. So this show is about personal finance, investing, business, all of the things that go into becoming financially savvy, investing with know-how and perspective, because you can get your news from anywhere, but it's the perspective. It's the perspective that counts. So let's just roll real quick the introduction, and then we are going to have a big show today. Dow is up massively today, and for a very good reason. Let's get into it. All right, we are back. Thank you so much for joining me. Again, it's Mitch Goldberg. This is an episode of Be the Boss of Your Money. I used to just call it a live stream, but I figured I had to give it a name. And I am really happy with the name because I want you to be the boss of your money. I want to make you better off financially. I want to make you the best financial version of yourself that there could be. So could you lower that, please? Thank you. We're on live. My wife's right here. She's listening to it, but I can hear it. So getting some feedback. So, let's take a look at a couple of things. First of all, if you haven't heard, we've got, this is tough to say. This is very tough to say. We've gotten numbers. I'm choosing my words very carefully regarding coronavirus, new positives, new COVID-19 positives, deaths, etc., between Europe, between Italy and Spain, and even in the United States, of the curve just barely starting to bend a little bit, to go from straight up to maybe starting to bend. Does this mean we're out of the woods? Does this mean it's time to run out and forget the social distancing? No, we don't want to relapse. And certainly we can't have a relapse because we're still in the thick of it. Things are just as bad as they were maybe 4 days ago, 3 days ago, and the crest is still expected to happen this week in New York. Ventilators are on short supply, if not possibly running out in the city of New York within a couple of days. Maybe the curve is bending. Maybe that time is pushed off. Maybe the social distancing is starting to work. Maybe enough governors of enough states have taken this seriously. Maybe enough people finally stopped playing your sports outside. Look, I love sports too, but maybe people finally took the social distancing seriously. And now here we are with a Dow up almost 8%, with an S&P up over 7%, and NASDAQ up over 7%. This is a pretty good day. And the fact of the matter is, if you take a look now, okay, I'm sharing a screen here. Get off that. Let's just take a quick look at the S&P 500. If you take a look at how much the S&P 500 is down year to date after this rally, I'm going to have a little news, little perspective for you, okay? The S&P is off 17.5%. You see this? 17.5% year to date. You know what? Being down less than 20%, I'm not saying from its all-time high, so maybe it's down 20 something, a little over 22, 24% maybe from its high, but year to date down 17.5%. We've been there before. Not the biggest deal in the world. And that's what we have to take into perspective. Markets have a way of overshooting to the upside, overshooting to the downside, where investor psychology overtakes market fundamentals. I don't think the stock market or any stock ever truly trades at intrinsic value. If you take a look at all the ratios, the value of the company's assets, the cash, you get this intrinsic value number. Stocks are always above or below, always trending up or down, depending on human psychology, investor psychology. And this is, you could see this playing out right now. So this is a reminder, like I've been saying for the last 2 weeks, things could go right. Things could improve. This is a health crisis that morphed into a financial economic crisis, not the other way around. Take care of the health crisis, you take care of the financial crisis, we get back to business. Will it be perfect when we get back to business? No. Will it be different? Yes. It could even be better, though. It could be better. And that's what today is all about. Listen, 2 weeks ago, when the major averages hit their near-term low, I came out and I said to you, that day, I have become a buyer. I said it. So there's a timestamp. You could go back to a previous version and see it. I said, I've become a buyer. And I've been a buyer for, starting the week before, actually. And because I came out with this really gloomy video. So that was like 4 weeks ago. I came out with a really gloomy assessment. It wasn't a prediction. It was a worst case scenario. And I said, usually you don't get a best case scenario. You usually don't get a worst case scenario. And people start to extrapolate bad news over and over and over in their heads until you get something so horrible you can't even fathom it. And I said, that's when I said I'll be a buyer. I kept buying until the following week. We had that nadir, that low. And then I stopped. I bought. I said I'm a buyer. You have a timestamp. Go back to the videos. I should have pulled the clip out. The point of the matter is, for the last few weeks, I've been saying you have to think about what could go right. You have to think that companies are going to do everything they can to survive. You have to look at the survivors. Not every company is going to survive. Not every company deserves to survive. The fact is, we've had a bull market for 10 years. The fact is, we had companies with massive, easy access to tons of debt and able to sell stock. So, as long as you have access to capital, you could still be losing money. You could still be an unviable company. But when you stop being able to raise money from investors, from issuing bonds, issuing debt, hitting your credit lines, when that all stops and you run out of money, you become insolvent. So there are some companies that won't survive, that I don't think deserve to survive. They're just no longer necessary. They no longer play an important role. Okay. But there are companies that do play an important role. So what we need to do is remember that things could go right. Hey, Bill, I saw you out there. Thank you very much. And I'm going to give a couple of shout outs momentarily. Okay. So is it time to be a bottom feeder? Because if we did hit bottom, should you be buying airline stocks, cruise lines, hotels, energy, some of the retailers? Because this is the stuff that really took it on the chin, the worst of the worst. And maybe they're not all going out of business. Maybe that if we're not going to be in a 6 month to 12-month downturn, maybe some of these companies come out of it. Maybe people start flying more often. Maybe enough people have, what do we call it, herd immunity in this country. Maybe a vaccine comes out. Maybe Johnson & Johnson does it. Gilead, or tons of other companies that are working on medications for this, okay? Maybe the social distancing is finally working. You have to think of what goes right, people. This is a positive message. Things go right sometimes. Things don't always go wrong, and nothing stays right or wrong forever. It's a cycle. So if you want to play value, how would you do it? I like both. I am a very diversified investor. Just by the way, when you invest in an index like the S&P 500, just want to say that you cannot invest directly into an index, but you could invest in a security that mimics a traction index. Now, I like both. I'm diversified. I'm a big believer in diversification. Not too much, but everybody has their own view of how much is too much diversification. That's a strategy that we use to mitigate risk, but it doesn't prevent your portfolio from going down in a generally down market, by the way. A diversification does not inoculate your portfolio from going down. Okay. So I'm taking a look at one of a pretty popular deep value ETF. It's been getting a lot of news lately. Okay. Let's just take a look at this, and I'm going to put it up on the screen so you could take a look for yourself. I've looked at a whole bunch of value ETFs, and I think it's important that you take a look. Okay. But this one here, okay, this is the DPV deep value ETF. It's down 42%. Year to date, down 44% in the last year. Okay. And if it wasn't for Gilead, which is up about 20% this year, okay, if you look at Gilead is up 20% year to date, exactly 20.01%. I don't know if you could see that right there, 20.01. Get back to DVP. But this would be down even more. But this has a lot of these stocks that I think a lot of people wouldn't ordinarily want to touch. Okay. That's what I think this is. So there were plenty of ways to get into this. So what are your thoughts? Do you think you should be taking a shot at some airline stocks? I mean, the down stocks, the energy stocks that could have a big bounce. After the Great Recession and bear market in 08, 09, value had a very good run. It hasn't had a very good run since. It had a short run, and then growth came right back into vogue. And it was all about social media, web-based, cloud computing, some of the consumer discretionaries. And, the value stuff, a lot of it was just left in the dust. Not to say that all industrial companies, which are often considered value, did poorly. But when it comes to deep value, there are a couple of deep value ETFs that are really bottom feeders that truly invest in the junky stuff. Okay, so what I did here, and then I compared it to another one. Let me get rid of this one, and I'll take a look at, for example, the RPV, which is the Invesco S&P 500 Pure Value, and that's down a lot as well. But that only invests in S&P 500 companies that the managers, Invesco thinks, has a value bent. And then there's VTV, the Big Vanguard Value Index Fund ETF, which is down 16.69%. Year to date, down 23%. Okay, so I said, remember, the S&P 500 is off 17%. So the funny thing is, value, now we're getting it, to the Vanguard fund. Value didn't really help you that much. It didn't. It wasn't like a preventative measure that kept you from losing more money than the benchmark index. So I'm still not convinced that value is the best place to be, but I think it's a place to be. I think for diversification, you have growth, you have value, you have consumer stocks, you have industrials, et cetera. So I just wanted to share that with you. And since we're sharing screens here still, hopefully that one will come up. Let me get back to my StreamYard. Okay. All right. There's a database I found. ETF.com has put together a database of 69 value ETFs. These are basically ETFs that have the word value in the name. And you could go from best to worst or worst to best. The RZV is the worst. It's a small cap value play. Small cap did worse than large cap. So it makes sense that would be at the bottom of the barrel. And the top ones, let's say Vanguard Mega Cap, down 25% year to date. I don't know what the exact date was that they have these, that they last evaluated these, but I'm just giving you an apples to apples comparison. Here's the VTV. So let's just, we'll get out of that. So that is a way to invest in value. So if you're looking for a quick and dirty way to invest in value, people are always asking me what stocks they should invest in. I don't mind that. I just can't give you the stocks on a live stream. It's something we'd have to talk about, and my compliance peeps would have a fit if I started making recommendations to you. Okay, so that is topic number one. Should the Federal Reserve buy stocks? Okay, the Federal Reserve, Janet Yellen, who was chairman of the Federal Reserve when Trump first became president, he replaced her with Jerome Powell. And she said Congress ought to consider allowing the Federal Reserve to buy individual stocks. Well, she said stocks. I hate the idea. And I had a little rant on LinkedIn about this today. And I said, it's a terrible idea. Actually, I could tell you what I said because I have it right here. Okay. But basically, It's enough that the Fed has become lender of last resort because it had to replace the private sector, which is pulled back on investing and lending. Okay. I said it's okay in my book that when the government bails out a company, it's okay if the government gets some stock in the company, because government money is really our money. It's taxpayer money. There's no such thing as government money, by the way. It's taxpayer money. There's no such thing as a government-funded bailout. There's a taxpayer-funded bailout. You see the difference? There's a subtle difference, okay? Government money is actually ours. It's not the government's. It's ours. So if the government bails out a company, I think it's fair to say that the government, we should get a piece of the upside. So I don't have a problem with that, okay, if it's necessary. I don't want to be picking winners and losers based on government intervention. And I'm all for, if the government wants to bail out a company, then let the shareholders get wiped out. Wow, that is a pretty heavy thing to say. I don't want to see stocks go down. I don't want anyone to get hurt. But the ultimate thing is when the government interferes with the risk-reward relationship of being a private sector investor, it skews everything. It creates something called moral hazard. Remember that term, moral hazard. We heard a lot about that in the Great Recession. Okay. It's one of the reasons why Lehman Brothers was allowed to go out of business, because Hank Paulson and Ben Bernanke were concerned about moral hazard. That is when people started to not worry about the risks they're taking and they stop judging their investments appropriately, because why should you? The government's going to bail you out anyway. So that's why I say, if the government wants to bail out a company, fine, but they shouldn't rescue shareholders, because shareholders took the risk. Now, I don't want to see a lot of layoffs. So if a big company has to get bailed out, that's systemic to our economy or an entire sector, I get it, because it could create bigger waves going forward. But shareholders shouldn't be protected, because that's how we evaluate risk. It makes us think twice before we hit the buy button and buy a stock, make any investment. It makes us do better due diligence. And when you take that away, you wind up lowering the economy permanently, because you lower returns, because you're reducing risk. And when you take the risk out, you take the reward out. And isn't that the whole point of capitalism, is risk and reward, acceptance of that equilibrium, of that relationship? I'm against the Fed buying stocks, creating winners and losers. And I think it's terrible for investors. Okay. So I don't want to see it. Let's take a quick look now. We're going to take a quick break and see who is out there. First, I'm going through LinkedIn. Okay. You see the comments through LinkedIn. Got a couple of people out there. Hey there, Howie. Can't make up for lost flights. People don't fly twice. Yeah, you're right. With airline stocks, it's, well, if I'm going to take a vacation next fall and I missed my vacation this spring break, no, I'm not going to take two vacations next fall. The money is permanently gone. Same thing with restaurants, right? It might not be the same with products, but definitely with intangibles. Yes, you're absolutely right. First in, that's right, James. Read one. Any tips for beginners, for stock investor beginners? I have a lot of tips. The first tip is make sure you're an investor or you're a trader. I spoke with a fellow yesterday, actually, and we talked about stocks, and he wanted to learn more. And I was talking to him about this, family friend. And what I said to him, young fellow, but based on his replies, I quickly realized that he wasn't talking about stocks. He was really talking about oscillators and charts and trading, and that's what he wanted to get into. Completely different ballgame. So know what your objective is the first thing that I would say to a beginner. I think one of these weeks coming up, I'm going to do live shows for an entire week about learning how to invest. Okay. Let's just take a quick look out there in Facebook land. Filippo likes the topic strong. Thank you very much. Hey, Bill, good to see you. Russell agreed. Man, thank you very much. I appreciate what you said. And it means a lot to me. Yep. Restaurants are the best example. Absolutely. So you and I completely agree. Okay. And I'll just take a quick look at Facebook to see who else is out there in my Facebook world. That's not the button I wanted to hit. Whenever you try to rush, you make mistakes. As my mother always says, that's what happens when you rush. So Judy's out there. I think I got a heart. And yep, thank you for the comments. Let's see who else. Okay, a couple of likes out there. Thank you very much, folks. Greatly appreciate it. And I'll be checking this again in a couple of minutes. Okay, so the next topic, okay, we were talking about good news in the coronavirus world. The coronavirus world. Is that weird to call it that? That we're in the coronavirus world? We're hunkering down. We're self-quarantining. We're doing all these things. So now I want to talk about a rule of thumb of stocks that I like to avoid. I think it's important that you know that, and we're going to get into that now. Okay, let me change one of my banners up here. Okay, all right. You see I put the scrolling banner down at the bottom. Couple of rules of thumb, but one in particular is this. I have found in my history of doing this 30 years that when a stock goes below 20, regardless of bear market or not, it's usually a pretty bad sign. And to me, it starts to become, as a category, it doesn't apply for every single position, every situation ever, but as a group, as an average, once stocks go under 20, it's investors have given up faith, given up hope in these stocks. But usually it tells me that there's a problem with the company, not just the stock. When they go under 10, it just reinforces it. And generally speaking, by the time you're under 20, the stock is hitting new lows. When they go under 10, new lows. And if they go under 5, to me, I'm thinking more like there's a bankruptcy coming than a rescue coming. Okay. And I avoid those kinds of stocks. If I'm in them, well, I wouldn't be in them because I'd get out of them when that happens. But if you're in them, I would rather just sell it, take the loss, and move on to something else. Doesn't apply to every single stock, but generally speaking, that's how I feel about them. I don't like to buy stocks at lows. It doesn't mean to say that I don't like to buy stocks when they're down. I would rather a stock go down to a low and wait for some news. I don't have to pick up the bottom. I don't have to get the most possible bang for the buck. I just have to have enough news and enough time and space so that I can be confident that I'm not buying a worthless asset eventually, that I'm buying something that can recover. That's how I feel. Okay. So it's not a matter of buying at year lows. It's a matter of, watching these numbers. But when stocks at 20, then 10, then 5, it's just worse and worse and worse. And I rarely see these stocks recover. I don't want them. Okay. I mean, you don't see Procter and Gamble going down to 20. You don't see Microsoft going down to 20. Are those good companies? This is not personal recommendations. It's not personal investment advice. I'm just giving them as examples. I have to say that. Okay. But do they go under 20? No. Did GE go under 20? Yes. Was it a buy? People thought so. It's under 10 now. Did Ford go under 20? Yes. Did it become a buy? No. It's under 10. That's my problem with stocks when they break 20. It usually means to me that there's more bad news coming. All right. So that's why the market rallied up so much today. We went over that. ETFs. Look, folks, that's about it. If you have any questions, hit me in the comments either now or later in the replay. And if you are watching this in the replay, I'd like to welcome you to the show as well. And if you have any questions, you want to bounce something off of me, you want a second opinion, you're welcome to come to me with that as well. Okay. I'll take one more quick look before I get going. Okay. Hey, Corey. Corey is watching on YouTube. The $20 rule. Yeah, we'll call it the $20 rule. Is that what you're asking? If we should call it the $20 rule? Yeah, absolutely. I'll go with that. Definitely. I would definitely be happy to go with that. Okay. And we got a quick comment out there. We got somebody else is out there. Thank you for the thumbs up, James. Really appreciate that. Anyway, that's the end of this episode. Thank you for watching. If you like what you see here, and you want to ask questions, certainly go ahead. If you have any friends out there that you think of who would enjoy watching my presentation, the live stream, let them know about me. I'd love to welcome more viewers to the stream. And that's it. I'm going to let you go. Have a great day, and I'll see you tomorrow, same time.